Hi, Peter Rose, Longwood Currency Trading. I got my coffee, and I'd like to chat with you a little this morning about, well, it was about a video that I just did the other day that was pausing Forex trading versus sitting on your hands. And I've had some discussions and stuff. I mean, at this point, I don't have a whole lot of subscribers, and I thank those of you who have subscribed and do comment to the channel. But I have friends and stuff that watch it and comment on some of the stuff that I'm working on. About the pausing versus the staging in. And an interesting thing came up among some of those that either don't trade and are just interested in hearing what I have to say or whatever. But what I've discovered in talking to some folks is that they're misinterpreting a fear of involvement with that of pausing in the trading or sitting on your hands. That question of fear of trading, fear of losing money, is probably one of the strongest detriments to us as traders as we sit down ready to hit bid ask. I think that we have to be very careful in making sure that our actions in not trading are not because of a fear, but because of a caution or a preparatory process or a process of trade entry and analysis, or even if you have a position that's running, just get the hell out of it if it's not going good for you, or set a safe stop point that's trailing behind and let that son of a bitch go, you know. But for those who don't trade these markets, it's very difficult to get across the concept that I've tried to get across to you guys in all of the videos that I've done, that trading currencies is probably the least scary of things that you could do from an investment or a wealth enhancement standpoint. I mean, I have a stock portfolio like everybody else did, and I've sold out of everything. I can't take that risk. I don't I don't know what the future holds. I've sold out of my last real estate from my portfolio and closed that whole business down. And I'm not going to buy another piece of real estate. Well, probably because I'm retired and I don't have to, but even if I wasn't retired, I would not be going into the real estate market right now. And those are not, oh, I don't know, they're not fears. They are the true manifestation of pausing. I don't know what's going on in the market. I'm just going to sit on my hands. I'm going to pause this whole thing, and I'm going to see what happens. Aren't you afraid of missing out? Aren't you afraid that a building might come by that you might want to buy? Or aren't you afraid that if you're not in the stock market that you're going to miss the continued rise? I got out of my stocks when the Dow was at 26, I think, 26,000 or 24,000, something like that, and that was up from where it was, and it's at 30 now. The stock, one of the stocks that I got out of, I lost $1.50 in a week, and I don't. That doesn't bother me. I'm safer in cash. The only reason that cash would hurt me is an inflationary process, and so we're not having any inflation right now. So I'm just not going to worry about it. But I do worry about stocks. I do worry about real estate, and I do worry about, you know, all this stuff. I've got a car for sale. Can't even sell the car. That's how much uncertainty there is in the market right now for taking a risk. I mean, my car is not in good shape. You've all seen pictures of the tank. It's time to retire the tank. It's a project car. It needs somebody to give it some love. And there's some people out there that just don't want to take that chance. They don't want to take that risk. We're in the middle of a pandemic. We're just clearing through the U.S. presidential election hoorah with all this bickering and division between the two parties in the United States right now. We're trying to pull everything together as we move toward bringing in our new administration. This pandemic thing is just getting worse. We've got an economic crisis that's manifested everywhere except the stock market. So it's really difficult to look at all that stuff. But I could look at the currency trading, and even though I'm kind of on hold right now until after the first of the year on that, you know, I look at the charts and I see, you know, what I would do. I've even thought, well, geez, I'll just go in and play in the demo account, and that's just stupid and contrary to everything that I believe in. I don't think you can trade effectively in the demo. Why would I go into a demo account? It's not the real thing. There's no emotion in there. I could lose $500. It wouldn't mean anything. I could lose $50. It wouldn't mean anything. It's fantasy land. You're not going to behave the same in there. So I'm not even going to bother to do that. But I'm not trading out of fear. I'm not trading because I'm anticipating great times. Right now, the markets are fairly volatile. The trade pair that I trade is just been going straight up, and I'm short biased on trading. I watch my friend Langers, the scruffy trader. He's on there every day making trades. He makes trades at the end of the day. He trades, and he's really successful at doing that. But he does it every day. That's what he does. And he just grows that account just a little bit every day. And he's really good at reading the price action because he's there in front of it all the time. Most of us can't be in front of it all the time. And even though I can sit in front of I'm retired, I can sit in front of the charts and all that stuff, that's not what I want to teach, and what I want to share with somebody is that you have to have that, I don't know, 500 hours, 1,000 hours of experience before you begin to intuitively see things. You're like a highly trained athlete. You're constantly on a diet and on an exercise regimen in order to keep yourself sharp. Look, I've taught martial arts for 50 years, and never once in my career, even after 6 months of training, did I ever want to put myself into a position where I was at such a heightened state of tuning that if I broke my leg or I got sick and came back 2 weeks later, that I would have lost my ability. I've trained in the martial arts from day one that if I ever got crippled up, I should still be able to do martial arts. Now, I might not be able to do a flying sidekick or something like that. Look, I'm 71 years old. I'm not going to be jumping around in the air or doing all kinds of rolls and stuff like that. And I haven't been able to do that for a long time. I was in a car accident in 1980, and it screwed my neck up, and I got involved in karate in 1968, and then had this car accident in 1980, and had to kind of take it easy as to what I was doing from that point on because of torn ligaments in my neck. But I was still able to do the karate. I was working out upper body stuff and walking even in the 3 or 4 years as arthritis was tearing up my hip. And even after I got my hip replaced, I was still teaching karate. I was still doing those things. I can't kick very high anymore, and I don't dare to kick very hard. My leg would come flying off probably. But I'm doing the karate because I trained so that the skills over time are ingrained and they don't require tuning. Now, somewhere in my 20s, I went in and did tournaments. Of course, I didn't do very many of them because I don't like that kind of crap. But I would train for that. I mean, I'd run and try to get in shape and do all that sort of stuff. But I figured when I went into the ring, I was as good as I was going to be. And I was only going to be in the ring maybe until I was 30 years old if I was going to do serious competition. So why was I doing my karate? To be in the ring? Or was I doing it as a martial art in order to come into peace and harmony with not only myself, but the environment around me and all other things? And so my training in currencies has been of the same thought. I don't want to be finely tuned. I want to be able to get up in the morning, not having traded for 3 or 4 days, grab my coffee, look at the screen and go, oh, you know, that looks like it could be an opportunity. Lay out some structural stuff on the chart and then see what happens. That's what the point of the whole trading process is. You should be able to do it anytime, regardless of how you feel. If you're trying to bang away there every day and you're trying to make goals, like you're running a hedge fund or you're running other people's money, well, that's a whole different story. But if you're a retail trader and you're just trying to increase your net worth, or as Langers does, he's pay himself a wage, you should just be able to walk up to the charts and, oh, yeah, there's nothing there today, and then go on about your business. Have a cup of coffee. And then, to get back to the original point of my video here, when you do sit down and you look at the chart, you shouldn't be afraid of the consequences the same way I would look very hesitantly at buying a piece of real estate right now. There's so many concerns in, because once you buy that piece of real estate, it's going to take you 2 months to buy it to start with. And then once you're in, it would take you 3 months to sell it. So it isn't something that you want to get into if you have any concerns or hesitancy about the market. You know, they talk in the stock market about dollar cost averaging. So regardless of how the market goes, you continuously put money in, and over the 20-year time frame or 40-year time frame, whatever it is, you will have appreciated that account by 8%. Well, that's great. If you start with $1,000 and that appreciates 8% compounded annually, you'll end up with X numbers of thousands of dollars in 40 years. And in 40 years, you could be dead 20 years before. Or right before you get ready to cash things in, because you've been compounding, you lose 40% of your market, like so many people did when this pandemic hit. And the market just crashed. It just wiped out retirement counts across the board. I have friends that have had to go back to work that were retired because their accounts are seriously jeopardized. They can't afford to draw income off of those accounts because there won't be enough of the balance remaining when the markets come back to have the account grow back. It's a terrible thing to be in. And so when you look at currency trading, I can get in there as a day trader. I can look at the situation. Hey, that looks pretty good. I think I'll go in and I think I'll take that position. And then, oh, whoops, 5 minutes later, it's like, oh, this isn't really doing what I thought it was going to do. I didn't get into the trade to have the price stagnate right after I got into it, or to go against me, but it's stagnating. It's not doing what I wanted it to do. 15 minutes ago, I had a plan, but I just got, as Mike Tyson says, everybody's got a plan until they get punched in the face. Well, I just get punched in the face because the thing is stagnant now. Well, the plan changes. It's got to change. Get out. It didn't do what you thought it was going to do. What are you going to do? You're going to wait around until it goes against you and so you lose money? I mean, I have more control over it than that. I'll close it out and I'll go get a cup of coffee and I'll forget about it for the day. I'm not afraid. I'm not going to be afraid of risking my money because I can always change my mind and I can get out right then. And I don't have to wring my hands and say, oh, should I put the order in? Would it take 2 hours for the order to go through? And I'm not sure that maybe in 2 hours things will fix it. I don't have to wait for that. because the liquidity in the currency markets is there. You're always going to have liquidity to do what you want to do. I mean, unless you're trading some friggin' off the wall double cross pair from somewhere. Well, if you stay with the major currency pairs, you're going to be fine. There's plenty of liquidity there. I mean, 15% of the retail, 15% of the volume. Well, this is a statistic from 6 or 8 months ago. 15% of the $6.6 trillion a day currency market in 2020. This is December, 13th of 2020. Of that $6.6 trillion market, 15% of that is Euro USD. So, you know, that leaves 85% for the rest of the market. And of those 6 or 7 or how many ever major currency pairs you think they are, they probably take up about 80% of the volume of the currency markets. And so, you know, that's a lot of liquidity. So what are you afraid of? We're afraid of being wrong, and you can't be afraid of being wrong. That was my problem coming out of the real estate market as an investor and starting to trade my first large account, because I was used to having a better thought out process, because I would not be able to get out of that trade. And so once you buy a piece of real estate, you don't start looking for reasons to get out. You know, you look for reasons to stay in. That's the problem with transitioning from real estate into currency trade. And I didn't get that right away, because I figured, well, risk is risk. Well, yeah, risk is risk, but the time frame that you're looking at is completely different. Because when you're looking at a piece of real estate, you build a case for why that's a good piece of real estate, and you look at all the risks involved around it. Is the roof going to be okay? Are they going to put a big farm up next door? Are they going to put all these other factors? And once you do your pros and con column, and the pros greatly outweigh the cons, you buy the piece of real estate, and then you're done with it. You're not looking about saying, well, in 2 weeks I'm going to check the market and see if I ought to get out, or in 3 years I'm going to do a trailing stop and I'll be getting out of that piece of real estate. You're buying that thing with the intent that you're going to have to hold that for 10 years, because you may very well have to do that. You may get out if you're a flipper. You could get out in 90 days and 120 days, something like that. But for most investors, it's 3 to 5 years that you'd be able to see. If you've got any kind of appreciation, you've got about an average of an 8% compounded increase per year on the asset value. And then if you did your financing the correct way, you've got cash on cash net against your down payment as your net cash as a percentage of your actual risk. And so at some point in a year you may say, man, this neighborhood is taking off. People are improving their houses, and I've taken a $130,000 kind of dumpy house and put $40,000 into it, so I'm $170 into it, and the places are going for $250. I'm out, and then I can go on to another piece of property. But we're not looking at 5 minutes, because as soon as you go into a currency trade, you got to be looking for reasons to get out, to protect yourself. And so you got to be sure that the liquidity is there. As long as you can convince somebody, and this is a problem that I have in talking with people about currency trading, as long as you can convince them of that fact, they should have no fear of doing it. But there are not that many people that think that currency trading is safe. They have a fear of the volatility and the spikes, and they say, well, gee, you lost $50,000. Well, yeah, I lost $50,000 because I didn't have anybody telling me the stupid shit that I was doing. And so I had to figure that out on my own. It cost me that much to learn that. You go into college and you take a 4-year degree in pre-med, and you get out and you go, I don't want to be a doctor. Well, you've spent $160,000 figuring out that you don't want to be a doctor. But you can take those skills and become a biologist or a biotech person and doing research. So it's not wasted, but you didn't get what you wanted to get out of it, you know, but it taught you something. So when I'm working with somebody, that's why I mandate that you only work with $1,000 account when you get started. And even for the first 4 or 5 months until you're absolutely certain that you've seen it all and you've been okay over that 6-month period of time with that $1,000 and that you've had a monthly increase of that of you know, maybe you're growing at 3 to 5% a month on that $1,000 account. Now you ought to be doing maybe 1% a week, or like I try to do, I'm doing 0.5%, which is $5 a thousand on a daily basis. Or that's what I try to look at on a trade basis. So I may end up 1.5% a day, and then some days I'll be down 8%. So it evens out. What I'm trying to do is lock at least 0.5% a day on average throughout my trading. And 0.5% a day, $5 a thousand. And you figure that out. If you could do that 4 days a week, that's $20 a week, right? $80 a month times 10 is $800 on a $1,000 account. That's an 80% increase. You're going to be able to do that? Well, I don't know whether you can do it or not. I was up 60% after 3 months at the start of 2020 until I got busy selling my real estate and the pandemic came and all that other crap, and then I just forgot about the trading and I had a little mini run against me, and I just, you know, I ended up closing that out for a huge loss. But then I was doing other things. So I wouldn't do that on a live account. I wouldn't let it go to a large amount because I can get out and I can get right back in. That's the beauty of it. So it's such a difficult sell when you're talking to somebody who's not aware of the market or who hasn't been introduced to it correctly as to this. It's not that the market is safe, it's that you can make the market safe if you have discipline. You can make your driving in the car safer if you put your seatbelt on, but you've got to have the discipline to put your seatbelt on before you turn the car on. That's a rule that I gave to myself. When I was in that car accident in 1980, I had a seatbelt on, and that accident could have cost me my life. It didn't. It just screwed me up for a couple of years. That car hit me on broadsided me. My head knocked against the driver's window, and it knocked the window out and threw the car up onto the curbside. It wasn't a severe accident. It just screwed me up for the rest of my life. I still suffer with pain as a result of that, but I'm alive, and I saved myself from an inordinate amount, possibly even death, by having that seatbelt on. Because I made it a rule that I would always put my seatbelt on before I turned the car on. That's just the rule that I had. And if I wouldn't have had that rule in place, I might not have. I don't give myself a choice when I get in the car. I get in the car and put my seatbelt on, then I turn it on. That's the process. And we do the same thing in trading. I do the same thing in trading. I put my trade on and I put an 8-pip hard stop there. If it hits me 5 times in a row, then I'm just stupid to have traded 5 times in a row against that same position, because I should trade it maybe twice and then go, oh, man, that didn't work. I'm 1.6% against my bank out. That's good for the day. I'm done. I don't have to do that. Because best practices say don't risk more than 2% per trade. I can take 2 trades, 3 trades almost, and get out on my short stop and be within the bounds of best practices. And people say, I got a short stop and I'm going to get taken out. Look, I don't go into the fucking trade unless I've got a probabilistic high level of confidence that the trade is going to go in my favor. Why the fuck would I go into the trade if it's jump ball 50-50? Oh, it could go, it looks like it could go up. Well, it looks like it could go down. Well, fuck, I'm not going to go in the trade. I'm going to wait. That's part of the patience in sitting on your hands, right? So I don't have any fear of trading, but I think a lot of other people do. Don't have that fear. Take a look at the market. Take a look at the stuff that, go back to my videos that I deal on risk management and stuff, and where I talk about risk. It's not risky. You're the risk. You know, the 19, was it 71? No, 1961? I don't know. There's a cartoon character by Al Kelly, Pogo, who said, I've seen the enemy and he is us. And that's true. We're our own worst enemy. We create the fear. We create the risk. The market doesn't create the risk. The market just trades, for God's sakes. Enough. Have a great day. Have a great trading day. Peter Rose, Longwood Currency Trading.